I think in this environment, as an equity investor, the U.S. definitely looks like the best place to be. Even from a fundamental perspective, you're seeing earnings revisions much better in the U.S., fundamental trends. U.S. is having a much better earnings season than areas like Europe. Analysts are still revising up numbers within the U.S. and compared to areas like emerging markets. So we think from a high quality asset perspective, the U.S. stocks look like a good bet right now.
Your target's 3,000 by year end.
Yes.
And you point out, even though they have tallies of how many times tariffs are mentioned on conference calls. You think guidance for Q2 was actually better than maybe you might have expected?
Yeah, it's surprising. I mean, corporates right now have a lot of excuses they could use if they wanted to lower guidance around, concerns around trade, uncertainty. But surprisingly, corporates have been very optimistic throughout earnings season. They've continued to guide in line or above consensus estimates, which have obviously been coming up. Yep. So guidance has still been very strong, and the companies that have mentioned trade, so far so good. That we haven't really seen CapEx expectations coming down. CapEx growth is very strong for the S&P in the second quarter, over 20%.
Ernesto, are you as constructive? And if some of these worries did creep into domestic plays, where would they show up first? Sales, hiring, CapEx, something else?
Well, we are constructive simply because earnings growth has been so strong, and the expectations for 18 and beyond that 19 are still very strong. And so far, as our other guest mentioned, the reporting has been very strong and the guidance has been very strong. In fact, as of a few days ago, 75% of S&P 500 companies had reported, and the growth in earnings year on year had been 26% relative to 20% that was expected. So a strong beat on earnings, a strong beat on revenues, and companies giving positive guidance, that is certainly a reason to be constructive. All the macro events and all of the trade chatter so far has just been noise. It will eventually translate into earnings, but until we see that filtering through in the reports and in the guidance, I don't think there's a reason to be negative on the U.S. market.
But Joe, wasn't the other takeaway from earnings season that growth stocks in particular are vulnerable?
Well, I think overall you've seen a lot of the growth-oriented sectors like healthcare and tech actually surprised to the upside in a big way. Healthcare saw a record proportion of earnings and sales beats. Tech saw very strong growth. So I think from a growth perspective, you're still seeing the fundamentals there where growth stocks look a little more stretched is on valuation and positioning. So you did see a little bit of a rotation in July into more value-oriented investments. So from a positioning and valuation perspective, there's risk that continues. But growth stocks fundamentally still look strong.